and welcome to the first session. Good evening, everyone. So,
Good evening.
good evening. So, just a quick round of introduction to Abhishek. Between Abhishek and Ejaz, I'll introduce both of you each one. So, Abhishek. So, starting off with Abhishek. Abhishek is someone Ejaz who has been working for, who's been working into stock markets and into the financial side of things, and he has been actively involved in financial modeling and he's presently working for Thomson Reuters, and he's based out of Bangalore. And Abhishek happens to be a previous student of mine when I was actually I was more into academia. So that's Abhishek. Hi Abhishek, welcome to MRM, Market Risk Modeling.
Thank you.
Okay. Uh, Abhishek, Ejaz is a very senior risk advisory professional working for one of the big fours and is based out of Middle East presently. He almost heads the organization from the Middle East side, and he has previously been with us for the credit risk modeling module, and he's back for the market risk modeling. Thank you for your confidence, Ejaz, and welcome to market risk modeling. Okay. Uh, so basically, uh, for the market risk modeling session, so as we proceed along with the market risk modeling session, rather let me put it this way: before we proceed so as we move forward with before we proceed to the market risk modeling session, so there are a couple of things that I would just like to discuss. First of all, is so basically talking about a few important things, talking about the materials first of all. So basically the course coverage, you guys have a fair idea because we have had you have gone through the brochure, right? So I will be covering all those aspects. So there would be a lot of time series modeling involved into the discussion. So there would be a lot of time series modeling involved this time, which was not prevalent, mostly in the which was not presently there while we had discussed credit risk modeling. So basically, there would be a lot of forecasting, there would be a lot of VAR, value at risk, and several such concepts, and a lot of mathematics. I would not say mathematics as such, but a lot of symbols over here, right? Because finance is all about symbol, and this is a very core finance module that we will be talking about. Now, so basically, yes, talking about the materials of analysis or the materials of study, that would be quite different from what we had seen, what edges you have seen in the credit risk modeling session. So since this time, I am the person who would be coordinating the market risk modeling sessions as well. So I would be sharing out all the recordings after the end of the class. So over the week, you can go through it. And another set of added material that would go out is in terms of the board works that I would be doing over here in the soft board. So I would be exporting them in the PDF format and circulating it, right? In addition to that, there would be relevant Excel sheets, and obviously, yes, SAS editor windows that would be circulated out. So in terms of material, this time market risk modeling is going to be more comprehensive, right? So this is the first time Abhishek is doing things on this platform with me. So I look forward to a very good a very interactive session like we used to have previously as well. So that's about it. And so today it will be more or less of an introductory session. So what is market risk? What are the different components of market risk? How does market risk fit into the regulatory framework? Why is it important? Why, from what aspect, or how is it that we can look to have? I mean, so why is it important? Why is market risk modeling important? What exactly makes market risk what makes market risk so important in the domain and in the business, right? So this is so basically we would be talking more about the scope of market risk modeling, and from there we would be gradually proceeding towards one by one. First of all, with an overview, then with the statistical techniques, and then we'll be pulling them together to explore the different modeling techniques that are mostly used in the domain of market risk, right? So just to start off, right? So as a starting point, it would be so basically as we start off. So the basic question that we always need to answer is what exactly is risk, or what exactly in particular is banking risk. So what are the different sources from which a bank faces the risk, or like the bank would actually so what are the different types of risk which a bank is generally exposed to. So when I talk about risk, the first thing that comes to my mind is risk implies uncertainty, right? So risk implies uncertainty, and when I talk about uncertainty, the most important concept, or the most important thing that comes out to me is the concept of probability, right? So when I talk about probability in specific, right? So from uncertainty stems out something called stochasticity. So when I say stochasticity is a technical term used for events which are driven by probability distributions. Say for example, if I lend out 100 rupees to a person, right, to a borrower, so then there is always some chance that the borrower will pay me back the money, and secondly, the borrower will not pay back the money to me. So basically what I have is I what I'm looking to is I'm looking forward to a full set of probability distribution. So there are probabilities associated with the possible outcomes, so I know what are the possible outcomes, and I know that with each outcome there exists a probability, or there is a probability associated with each and every outcome. However, what I do not know is what exactly is the probability that a particular, or which outcome will realize in which particular trial. So stochasticity is something, it's a scenario which is driven, or which is characterized by probabilities, right? Now, where is this stochasticity created? Due to risk. And when I say that risk creates a lot of stochasticity, or risk brings along with it a lot of stochastic events, so where is this stochasticity created? So this stochasticity is created in the cash flows of the bank, right? So it is created in the cash flows of the bank. So the bank, so what becomes,
Just
yeah, yeah, Abhishek.
one question. The meaning of stochastic.
I'm coming to that, Abhishek. I'll come to the technical side of things. I'll come to that.
Sure,
Yeah,
sure.
yeah. So basically, so when I say, so basically yeah. So as I was saying, risk, from risk it comes to uncertainty, and from uncertainty relates, or it creates stochasticity in the cash flows. So let's use an example before I move into that, right? So for example, there is a bank, right, which is lending out to a particular person. So I have a bank. So or there is a loan of some amount which is being lent to a particular person. Say a loan of 1 lakh rupees is being lent out, right? So there are two borrowers, or there is a borrower to whom this loan is being given. Now there are two probabilities. One is the borrower will default. The second is the borrower will not default. And now to this there is always a set of chance, or there is always a chance which is involved to it. So basically there is a 30% chance that the borrower will default, and there is a 70% chance that the borrower will not default, and there is a 70% chance that the borrower will not default, right? So there are, So there is a whole set of probability which is associated over here. So probability, so the distribution that I have over here, so to this I have, to each of the outcomes of this particular event, or to of this particular occurrence, I have two possible outcomes, right? So this default may occur with a sudden chance, and the non-default may occur with a sudden chance. That means what, at the crux, what I see is that they're getting back the money is uncertain for me. So I'm really very uncertain about the fact that I'll get back my money. So getting back the money is not a sure event, right? So if it is not a sure event, then it is called a stochastic event. So a stochastic event or a probabilistic event is one which has a probability distribution associated with it. So if the event is such that there are different outcomes and each outcome has some probability of occurrence, then that event is called an uncertain, a probabilistic, or a stochastic event, or as to say a stochastic outcome. Clear, Abhishek?
Yeah, it's clear. So any event where there are more than one outcome, so it can be referred to as a
Yeah, so
stochastic event.
basically, which is, or more importantly, where there is a probability distribution. So where the outcomes are probabilistic in nature, right? So for
Okay.
example, if I
Okay.
invest in a stock market, so if I invest in a stock, right? So there is always
Yeah.
a chance that the stock price may go up, the stock price may go down,
Yeah.
or there is an average return and a variance, right, associated with every
Yeah.
stocks. So when you look into the
Yeah.
average return and the volatility, what does it say? It says that on an average you may get this return with an average
Yeah.
variation of this. That means what? I can get any
Okay.
values between that average and plus minus 3 sigma, right? So that means,
Exactly.
what? So there are a lot of possible like possible return values that I have, and to each return value there is
Okay.
a probability of occurrence, right? So if I
Okay.
am investing
Okay.
today, I know that the average return is 100 and the plus minus variance is say 5. Okay, so then I can
Yeah.
always get an outcome between there is a 99.99% chance that I'll get an outcome between
Yeah.
85 to 115, right? So
Yeah.
that is what I
Yeah.
know. So therefore, so that means what? So there is a whole probability distribution associated with all the return values that I may get. So between 85 and
Yeah.
115, I might get multiple returns. Now, which return I will
Yeah.
exactly get, that is what I don't know. So that means that outcome
Okay.
is characterized by a probability distribution, right? And
Yeah.
hence that is stochastic event.
Okay. Got it. Thank you.
Great. Great. So this is what the con. So this is, so whenever you are actually lending out, or whenever a bank is investing into assets, the bank knows that there are certain chances that their returns may not realize. They may lose out on the return. They may make a gain on the return. If they make a gain, so there is a certain percentage of a gain that they can make. There is a certain probability to that. A certain loss that they will make, there is a probability to that. So everything is determined by probability, and therefore the cash flow that will come for the bank, that is also stochastic in nature. So the existence of this uncertainty in the lending environment does not allow the bank to have a fixed cash flow. So it is not that, like in a, for a salaried person, every month we will get a fixed cash flow at the end of the month. It is not like that, right? So as an organization, so even if I think about DexLab as an organization, our cash flows are also stochastic in nature. So there is always an element of risk involved in whether, when given that a person approaches us, what is the probability that he will get converted into a customer. So that there is a cash flow. So I mean there is a stochasticity involved in every possible outcome, right? And this risk is something which is characterized thoroughly into or is ingrained into the business domain. So So our objectives as a bank can never play a very safe game, right? So the bank always has to take some risks, and taking risk is the business of the banks, right? So basically, if I think about a bank's strategy, so then let me talk about a bank's strategy. So as a bank, I have two options: lend out 100%. First is lend, and the second is not lend. Not lend. So not lending is perhaps the safest exercise that a bank can do, right? I'll not lend. I'll not create any credit. I'll not lend. So over here, the risk involved is 0%. So the bank is not lending. Now the next part is where the bank decides to lend everything. So basically, if the bank in deposits they get 100 rupees, they are lending out the entire 100 rupees. So if so, the risk is 100% if they lend the entire amount. So now the over here when the bank is lending, the bank has two business problems. The bank has two characteristics. One is lend 100% of the deposits. So whatever deposits the people are keeping in the bank is investing it or is lending it in total. And over here is lend out some X%. Now if the bank is lending out 100%, the risk that the bank runs into is also a 100% risk. So assuming that there is a huge default and the bank does not keep back anything as reserves or against as provisions as bad debts, and let's assume that all the borrowers who have taken the credit they go into defaults, then the bank will obviously go in for a collapse. So when the bank is lending and lending out 100%, the risk that they are exposed to is 100%, right? So neither this, so this is obviously not a feasible stand for the bank, and this is neither is this a feasible stand for the bank, because in this the bank runs a risk of bankruptcy, and over here the bank runs a separate kind of a risk that if people are keeping the money in the bank, right, so they can act just as a safekeeper of the money, as a locker, nothing else, right? So there is no growth. Now what the bank generally does is, or any bank, they generally try to take a path in between where they need to optimize between risk and growth. So for the biggest optimization problem that any bank has to solve is a risk versus optimization, or basically sorry, a growth versus conservativeness, or growth versus stability kind of a problem, right? So basically what they do is growth versus conservativeness. So what they basically try to do is they try to understand that how conservative is a particular account, or how so basically they need to understand how conservative they need to be vis-a-vis how much growth that they desire. Now this is driven by a lot of this decision is a very subjective decision, right? And you cannot always solve a vis-a-vis a mathematical optimization problem and solve it. So however, there is a growth versus a conservativeness kind of a debate that the bank has always to solve, right? And it is this part that we need to address, right? And it is this part where this entire concept of risk management comes in, right? So this entire portion, so if I talk about growth versus conservativeness, so it is this entire portion where which gives birth to the problem, or to the land, to the business of risk, management. So I need to take calculated risk as much as possible. So this is where it talks about the risk management.
So, in a nutshell, we can say it's about finding the correct X.
Exactly. And that is where the entire challenge arises. Right. So if I'm trying to find
Okay.
out that
Okay.
X% that I must be either investing or I must be lending out. So what is that optimal X? That is where this entire game comes in. So that is where this entire risk management principle comes in, where you need to analyze the different risk sources that a bank faces and how is it that you can manage the risk at each of these different portions, right? So yes, Abhishek, you are actually correct when you say that this is the X% which is there, right? And I need to optimally determine this X%. How much of the total funds should I be investing somewhere? So how much of this funds should I be lending out? And decisions like that, right? So, and as a part and as a interest rate differential, the banks makes it profit. So what the bank does is the bank borrows from a low risk segment, which is the depositors, and give them a relatively low rate of interest and use those funds in relatively high risk situations, like which might be used for investments, which might be used for lending out. And from there, what they do is they get a high rate of return, and the return interest differential is the profit of the bank, right? So the entire profit of the bank is contingent on the fact that the money comes back to the bank along with the return, which probably did not happen at the beginning of the financial crisis, right? So in those crises, I mean, if you look into, if we go back during those pre-financial crisis days, we would see that the economy was actually booming, right? So after the 9/11 attacks, the US economy, or rather I might go back even a bit. So at the beginning of this century, in the year 2000, so what happened was there was the collapse of this dot-com bubble, which was there, which US has been experiencing, where the you know the prices of the IT stocks were soaring sky high, and following a market correction, these stock prices started coming down, and the dot-com bubble actually collapsed. So when that bubble actually collapsed, there was the US markets had faced a huge amount of loss, right? So huge amount of loss in the such that a huge amount of market wealth was actually lost in those stocks when people actually realized that they had overpaid and over invested in the stock, and they could not recover it from the markets, right? So following that, the US economy started going into a recession, which got aggravated in the year 2001 following the 9/11 attacks. Now, after that, the US economy had gone down to a kind of a very stringent recession. Now, to overcome that recession, they needed some very outlandish idea. And this outlandishness of the idea was driven by expanding consumption expenditures. So, it is a basic economic theorization that if your economy is a demand driven economy, like most economies are, then if you are actually going down into a demand trap, right? There's a low demand, low aggregate demand, creating low supplies, which resulting in unemployment in the long run. Then what you need to do is you just need to boost in the expenditures in the economy, and those expenditures will keep on actually multiplying the output and then the income and then the output in an accelerator framework, and will keep on boosting up your economies. And that is what us had actually done. What they started doing was they started boosting up the consumption expenditure, and as such the rate of interest on the consumption loans were cut down as low as 1%. Now, following this, what happened essentially was that the consumption sector actually expanded. Now, as the consumption sector expands, what happens is the aggregate income of the economy starts going up, right? And as the consumption So basically what happens is, say today I see that the consumption expenditure in my economy is going up, right, and the retail sector is actually boosting. So next comes the demand for credit to finance that consumption, right? Now, so that boosts up your retail portfolios of the bank in terms of secured and unsecured. So in the essentially in terms of unsecured lending. After that, what happens is, following that.
Can you just repeat the last part? Can you just repeat the last part once? Like after the consumption expenditure
Okay,
had
okay, okay,
increased
okay,
for
okay.
economy.
So
Yeah.
basically, when the consumption expenditure for an economy increases, right, what happens is, so basically, producers from the production side, the producers expect an increased demand for their products, right? So by now, the inventories that they had accumulated, they rapidly start running down the inventories. Now, if they have to rapidly run down the inventories, they need to create an added demand on the. I mean, they need to have very strong demand on the other side. So, in order to
Yeah.
do that, what is done is the rates of interest on consumption loans are slashed down. So, if I'm not mistaken,
Okay.
if I remember correctly, during immediately after the crisis struck, like the after the 9/11 attacks, after some time, say a quarter down the line, the rates of consumption loans in US was slashed down as low as 1 or 1.5%. So that
Okay.
was the Alan Greenspan era. So Alan Greenspan was the Federal
Mm.
Reserve chairman at that point of time, the Federal Reserve governor. So what? So basically, when the interest rates of consumption loans get slashed down, right? Now, what are consumption loans? How are consumption loans financed by the households? They are financed by credit cards, or they are financed by these credit cards, then you have personal loans, etc. So basically, the demand side, the credit demand and the retail portfolio of the bank started expanding. Right now, with cheap consumption loans and cheap access to consumption credit, consumers started expanding. Consumers started buying more and more of consumer goods, and the inventory which had accumulated over a span of time due to slack demand got run down fast. So as the inventory started running down, now came the requirement for added production, and that is where the employment also started gradually expanding, right? And as employment starts increasing, the overall the average income also starts improving over a span of a quarter or a couple of quarters. Now within 1 year, it was seen that the consumption expenditure has increased, and the overall aggregate income of us had also increased in the years 2003 4 like this. Now when on an average the economy's income starts increasing, what happens is your demand for housing starts increasing. So people start demanding more and more houses, because the moment I start start earning high amount of income, what happens is I requirements for real estate products also start increasing, right? So what happens is, you would see that whenever an economy is growing, or it overcomes the recession, it starts expanding, it's in the recovery phase, the as the GDP increases, the real estate prices also keeps on increasing. Right now, following that, what happened is, the banking system started playing its own game. What they said is that, fine, you are a consumer, and my expectations are that the housing sector is actually growing, and the housing prices are escalating and they are shooting up. Now, I assume that you are a borrower who does not have the capacity to pay back the loan, but you have the house, and that house price is increasing. So even if you are unable to pay back, I'll mortgage your house against the loan that I'm giving you for your house, and I'll recover it by selling your house, because the house prices are increasing. And it was seen in the US that across different regions, there were some regions in Florida and some parts of US, where in the south coast, the north coast, and so on, where the housing prices had shot up at 114% in the span of 2 years. And the overall housing prices in the US economy as a whole had shot up between 70 to 80% in a span of a couple of years, which was way below, I mean, which was way above what the fundamental rates of increase used to be. So people could realize that the demand for housing segment had actually increased. Now, what the US people or the US banking system tried to do was they tried using housing or real estate as an instrument to give more and more credit, to play that credit game. So suppose today I have a house which is worth 2 lakhs, right? And in a span of 6 months, I realize that okay, my house is now worth 5 lakhs. So what I do is now I am now eligible for an additional loan of 3 lakhs from the bank, and the bank would give it against my housing assets. Now, the problem on the side of the banks was that the banks did not realize that housing prices were way above what the long run average trend was, and now it was actually shooting much over what over the long run average trend. So the long run, I mean, if I'm not mistaken, the housing prices were nearly 112 to 200 times over the above compared to the long run average trend in US during the period of 2005 to 7. So what happened was that after a point of time, the market started correcting its market started setting its expectations back, and they realized that they were actually overpaying for the houses, and that the houses were thoroughly overpriced. Now when this market correction came in, when the expectations on an aggregate got corrected, right, expectations got reset, that is where the housing prices plunged. Now, when the housing prices plunged, the banks entered into a terrific amount of loss, because now they could not. Now there would be huge amount of defaults because people would not be able to pay back whatever loans they had taken, whatever houses they had taken, and against those houses, by selling those houses, I cannot recover what I had given, the loan that the bank had given, and hence the banks faced huge amount of losses. Now these were huge amount of toxic loans, right, which were written of the bank's balance sheet. And how were they written off? So that is where the role of the investment bankers came in. The investment bankers started designing very specific specialized instruments, right, out of these loans, and they designed it into very, into very attractive derivatives with attractive ratings, and they put it on show for international investors to pay their money in. And when huge financial institutional investors had invested in those bonds, right, now it was realized that, so once the housing bubble collapsed, right, so those derivatives also became opaque, and like if people could not repay back the money, there was no chances of recovery, right, and hence Lehman Brothers also defaulted on the repayment of on the payment obligations, and huge amount of funds from investors all across the globe got trapped into these uh, these specific instruments, which were no more tradable, right? So the entire globe at that point of time was actually riding a bubble base which was way above what the fundamental values of the assets could be, and the entire system, they entered into play this game, right? And when the bubble actually collapsed, it was realized that the total cost of the total loss which was caused within US itself was around 3 to 4 trillion dollars. No, sorry, it was around $13 trillion, and across the globe wide, I don't remember the figure, but it was much more. It was a very pathetic scenario where the government finally had to step in to make the bailouts. Now, this the fact that, so in the entire event had happened, originated in the US and could have collapsed in the US had the investment banks like Lehman Brothers and like Morgan Stanley and some of these Merrill Lynch and all, they had not, they stepped in creating these special instruments, these opaque instruments, and sending them off globally. So when the global investors stepped in, and when these big investment banks collapsed, the investors' wealth also went along with it, and a huge amount of property worldwide was actually lost, and hence the entire world entered into a global recession. Right from India, in fact, ICICI was a bank which had invested in huge amounts into these securitized assets, which where they lost huge amount of wealth. Right now, what had happened into for these institutions was, and this entire crisis which had resulted out of this entire thing, or out of this entire behavior, as I would say, this entire crisis had happened because the regulators were not there. So there was no regulation, there was no control on, you know, channelizing the investors' money, and the banks mostly had taken this 100% loan strategy where they were actually lending out almost 100% of their funds without keeping the appropriate provisions for bad debts. And they were just writing off all the toxic assets of their balance sheet by creating specified instruments, special instruments. Right. So the off balance sheet assets were actually very toxic. So now once this global and so basically when this entire financial system collapsed, right? So regulators all across the world realized that it's now time that the financial order be regulated. The properly the risk associated with the behavior of the with the banks, the sources of risk associated with the banks be assessed properly, and based on that the decisions be taken. So from that perspective, the entire so basically from here, this overall entire regulatory framework and the assessment of each of these regulatory frameworks, like be it Basel Accords, be it your CCAR, be it DFAST, or be it other regulatory stuff that had come up. Right now, it's a time for IFRS 9 implementation and stuff like that, CECL and all. So in in respect of this, or against that background, these regulations actually came in play, where each of these regulations emphasize on two very simple facts. Number one, each of the sources of risk which a bank needs to or a bank is exposed to must be properly analyzed. Number one, and number two, adequate capital should be kept back, which would help the bank to sail through periods of downturns. And if there are defaults, or if there are losses which the bank faces, then the bank must have sufficient amount of capital stored back, which would actually help them prevent themselves, or you know what should I say, cushion themselves against the huge losses that they may face. So having said that, right? So having said that, all these regulations and all these model developments, all these model validation activities have come into play, right? So this is mostly the background under which all these the increasing risk for credit risk model development, market risk model development, operational risk model development validation have come up. I would not say come up; they had always been there, but the emphasis on these models have increased separately. Right now, regulators know that I must assess all the risk that the bank faces. I must keep aside sufficient capital for the bank to prevent itself against losses. I must keep aside capital which will prevent the bank to to move against or to survive through periods of extreme downturns, which is called stress testing. So basically, I must have models which will help the bank decide on proper investment avenues. I must have models which will help the bank decide in a quantitative manner, plan out its amount of credit that it must be giving out to people, to whom it must be giving out to people, how much of credit it must be giving out to people, how much should it invest, in which are the bonds or which are the assets that they should invest, how much they diversify their portfolio, and so on. So there are a lot of these regulations which have come around in helping the bank, or in determining how the banks must decide on their operations, right? And in this aspect, we will be discussing one of the major sources of risk, that we call market risk, the risk to which banks are exposed based on their investments. So how much of assets that they must invest, right? So which are the shares, or which are the assets where they must go ahead and invest? What are the different types of investment instruments? What are the different types of risk to which the bank is exposed following the movement or following the fluctuations in the in the market scenario? So, talking about the credit risk side of things, so over there, the risk management takes the form of deciding that when a obligor comes in asking for a loan, how much of loan should I be giving, to whom should I be giving the loan, how much of credit must go in, how do I monitor how the performer borrower is performing, based on that, how do I take decisions for building a scorecard, and so on. Right. So over here, our focus would be, or to, would totally be on and assessing how much of credit, or how much of like how should, or to decide, to understand how would bank decide on investment opportunities, right? So what are the different investments, what are the different instruments of investments, what are the different sources from where market risk might arise, right? How do I predict the market risk, etc., right? So this is mostly a overview of the discussions that would be done. So I'll just take a pause over here, and I would like to take up any questions. I mean, questions if there are any.
So
Great.
by referring to market risk, which are the market from which we can expect a
Yeah,
risk
I'm
that a
coming to that.
bank
I'm
might
coming to that. I'm coming to
face.
that detailed description. I'm just coming to that. Okay. Okay. So before we move on to talk about market risk and all. So before I move into the you know into the different, into the broader aspect of market risk, so there is one major factor that we need to understand. I mean, understanding how this factor operates, right? The justification for understanding market risk as to why we study market risk, why market risk should be studied, will be very clearly specified, right? Now, one thing to understand is that if you look at the global financial order in the present day, we can see that the global financial order is highly integrated, right? So country A is connected to country B to country C to country D, like this. Now, if they are connected with each other, right? How are they connected? They are connected through trade and business channels, right? And through other financial linkages, out of which one very critical linkage is that of multinational corporations. Now, when I talk about multinational corporations, so it's a very broad term. So, if we'll be just focusing on the you know on the financial sector side. Say for example, I have say for example, let's take HSBC. So, the Hong Kong Shanghai Banking Corporation is a bank which is headquartered in London, right? And that's their mother country of operation. However, they have significant operations all across the globe, across all the continents, right? And it's not that their global presence is insignificant. They have a very significant global presence all across, right? So if they have a very significant global presence all across, what they need to understand is, so that means they are very important players when it comes to exploring when it comes to exploring the employment, or I mean to influence the employment output of the nation. So each of these, so HSBC as a banking organization has played a very critical role in determining the employment factors in a region, the banking in a region. So basically, what would happen if HSBC collapses suddenly? So if HSBC collapses today, then there would be the first impact that would be, there is at around 75 to 80,000 people would immediately get unemployed all across the globe, or it might, though the number might range to millions as well, right? So there might be a huge number of people who just get out of job. So the global, although the globe can experience a recession the moment this bank collapses. Why? Because this bank is connected very significantly, and this bank has significant exposures in each of the banking, each of the international portfolios. So standing from there, what we can clearly see is that an organization like HSBC is very important, not only to the region where it is operating, but to the globe as well. So such organizations are called globally systematically important financial institutions. That is GCFIs, globally systematically important financial institutions. So they have a huge extent of interconnectedness between the geographies. So if any upheavals happen in the London headquarters today, and there are any major shocks that the London headquarters faces, then there is a huge chance that there would be a set of shocks which will ripple through the different geographies. Say, for example, London UK portfolio today shrinks, right? Or the bank collapses in UK. The first and the most direct impact is there would be a cost cutting, and there would be huge amount of employees who would be ramped up, right? And that leads to an increase in unemployment in UK first. Now, the moment this happens, if the UK operations get slashed in one of the countries somewhere over here, so be it in India, be it in China, or be it in somewhere across the globe, be it in Hong Kong, there is a team which is supporting the operation. So there is a BPO team which is supporting the operations at UK. So that team gets ramped down, right? So similarly, then when headquarters ramp down, there is a loss of confidence. So people would be drawing out funds from that bank. As such, the deposits with the bank will shrink. The bank's capacity to earn profits will actually shrink, and hence the bank will start cutting down employees more. And there will be a spillover impact from UK to India and to other areas wherever it is operating, right? And as a result, on the whole, a set of, there would be an increase in the unemployment. So if a globally systematically important financial institution collapses, it has long reaching effects on the globe, like the likes of Lehman Brothers. So when Lehman Brothers actually crashed, the world entered into a recession. So till before Lehman Brothers crashing down, it was the recession or the impact of the downturn was limited to US. But the moment Lehman Brothers crashed, this is the thing that had happened, and the entire globe entered into a downturn. This is where the entire problem happens, and that is why you need to be very sure that your globally systematically important financial institutions do not crash, because if they crash or if they collapse in any possible way, it would not only lead to a huge recession, but it would also impact the stock markets as well, right? There would be huge amount of wealth loss all across the globe, whoever has invested in the stocks of that organization. Right? So, for example, HSBC itself is a very reputed brand, right? And hence the investment into that, and hence the stock prices are expected to be relatively high, or to be very high in the markets where they are listed. Hence, it is very important that such organizations, such institutions are managed carefully, and they are prevented from collapse in any possible way. That is the reason why so many regulations come in place. So when the bank, as a bank, HSBC is into lending to customer, consumer, and for commercial lending, as well as it is also very actively into investments, right? Investments and financial market activities. So they have their own bonds. They invest in bonds, debentures. They invest into other banks. They lend into other banks, and So there are a lot of different opportunities that they indulge into in order to increase the profits from the markets. So now when HSBC interacts or say invests in stocks or bonds or into assets issued by other banks or other financial institutions, right? They expose them to some kind of a risk, right? So they expose them to different kind of risk like interest rate risk. They've exposed themselves to exchange rate risk. They expose themselves to asset price risk. Now, suppose if HSBC is actually investing in an asset which is perhaps riding a bubble, so given that the bubble collapses, HSBC loses out a huge amount of value on its investment, and hence there's a huge loss that the bank actually occurs. Now, this shock will have its tremble somewhere down the line, which will actually affect the macroeconomic stability of the organization. So, from India's perspective, State Bank of India is a globally systematically important financial institution. Within Indian demography, ICICI, HDFC, or HDFC banks are systematically important financial institutions because they are major banking players today. So having seen this, having seen that, what we can clearly say is that such institutions need to be very carefully monitored. They need to be carefully regulated in order to prevent them from collapsing and to ensure that they survive periods of extreme downturns as well. So this is why these regulations have come up with the increase in the number of globally systematically important financial institutions. And these financial institutions, when they have their exposure to the asset markets, to these kind of markets, when they are exposed to macroeconomic or market driven risk, and the analysis of such risks is called market risk. Now, market risk is when I talk about market risk, the question comes out that what type of a market? The market can be any kind of a market. Say asset markets, it can be risk which is affecting like the interest rate risk, it can be counterparty risk, it can be exchange rate risk, and a host of other such factors, asset price risk, and so on. So any
So, so just to interrupt one, so any a- any entity, any organization, or any person with whomever the bank is investing is a market.
Uh, no, the market, Abhishek, is defined in the common term that we understand. So it is not a market as in a physical marketplace, but it arises for an asset where there is a demand and supply, and it's a non-lending asset. It's a non-credit asset, right?
Okay.
So basically, it's a
Okay.
loan or a personal loan or a mortgage loan or a credit card does not fall under market risk because that's a credit product. Market risk mainly bases or talks about factors or those assets which are there, like which are traded in the markets and are affected by market price fluctuations. So I might be
Okay.
talking about any kind of a tradable asset in that case. So any tradable asset market. Now, so for example, exchange rate. Now, exchange rate is not a market as such, right? So there is, so yes,
Yeah.
you might have, if I think about, yes, you are hedging yourself against exchange rate fluctuations or stuff, but exchange rate factors are important factors which affect asset prices or transaction in the asset markets, right? So they affect import export. So in that way, it is a source of a market risk. It's a non-tradable risk. So I mean non-tradable mean I mean it's a non-credit risk. So any kind of risk which is affected by macroeconomic and market fluctuations fall under market risk.
Okay.
Right? Great. Ajaz, any queries up to this point? Great. Fine. So So just to talk about some of the major kind of market risks, right? Some of the major sources of market risk. Sources of market risk. Right. Now, market risk has different kinds of risk, or I mean, the market risk may stem from different kinds of risk, as we discussed. First is an asset price risk. So, asset price risk. Then you have liquidity risk, also interest rate risk, interest rate, right. Then you have exchange rate risk, risk, and finally what we have is the counterparty risk. I'll just increase this one. So the next what I have is the counterparty risk. The next is the counterparty risk. Next is the counterparty risk, right? So there are these different sources of the risk. Now, how is it a risk? Right. So let's just start off with the asset price risk that I've been talking about. Now, so over here, when I'm talking about say asset price risk, so what I need to know is, or so basically, how is it that I can define an asset price risk? So basically, when I'm talking about an asset price risk, I'm talking about say basically the stock market risks, right? So the price, so there is an asset A which is traded in the markets, right? And there is always a speculation which is going on in the market. So now the question that comes out is, okay, I see that the price of an asset has been increasing, and it has been increasing, say exponentially, it has been increasing over a span of time. So, so when I do this, or when I look into this, so basically I have been monitoring the asset price, the value of asset price over time, right? So let's say this is the time variable over here, the time. And over here, what I have is the price of the asset, or the price of the asset over time, that is PT. Right. Now, what I see is that the price of the asset is going up. Say basically, this is the price of the asset, which is. So, can you name an asset in the very recent time where such a movement has actually been seen? You've seen this kind of a
Just the
movement.
example which
Bolo?
just the example that we discussed, I guess, the housing one.
No, no, the housing one is okay. So that has happened in the history. I'm asking about the most recent times in the recent few days. Right, Ajas? It is the bitcoins. So over there, the bitcoins asset price, the price of bitcoins have been seen to increase like in a super exponential manner. Right, so it has been seen that the price in bitcoins have been increasing exponentially. Now the question that comes out over here is, so the question that comes out over here is whether is this rise fundamental in nature. So is it driven by the fundamentals? Is the price increase fundamental in nature, or is it driven by or is it driven by irrational exuberance? So is it driven by the irrational exuberance? So irrational exuberance is a term which talks about, it's a behavioral term which comes out where like people do not ration out their information set. They do not have ration out what are the available information, right? And they take just the decisions based on what others are doing. And at the back of the mind, they are working as per a herd mentality, which talks about measures like, where they are just investing because they feel that why if others gain, we would stand out. But if it falls, then everyone will fall together. So that is what is irrational exuberance. So irrational exuberance is a tendency of investors, or it's a kind of a partial blindness of the investors, right? Which they actually, through which what they try to just imitate the market patterns without thinking much about it. So it's a kind of an extreme speculation scenario where the asset prices keep on rising exponentially and such that they go over above the fundamentals. Right. So this is what is the overall idea about the fund. I mean, about,
Just a question
yeah.
about
Hmm.
irrational exuberance.
Mhm.
I just thought of this.
Uh-huh.
So, say suppose a company is a very big brand name,
Hmm.
say HSBC,
Hmm.
IBM, or in if I talk in India, Tata, SBI.
Right.
So they already have a reputed name in the market.
Mhm.
So any guy who is investing, say he is a new investor in the market
Okay.
and he is not that much a risk taker.
Huh.
Say suppose so then if he or she is investing
Mhm.
and he goes by the name of the company, the reputation of the company,
Hmm.
that this company stocks are not going to go down
Hmm.
very soon, or I'm not going to
Hmm.
incur a huge loss on this one if I invest. So is can that be named
No,
as irrational exuberance?
that is not irrational exuberance, Abhishek. The reason is because HSBC has a line of business, it has a market share, it has a repute. You know what the business plans are. You have a project and you have a profit statement of the bank for the last 5 years, 10 years, right? Now, irrational exuberance is something caused by possibilities, not results, right? So let's take the case, for example, let's go back in time, right? Let's go back in time at a point of time in the year 1994-95, right? So where Amazon was coming out fresh, Google was coming out, right? Now you did not you could what you could decipher was that it was ushering in a new age, an online age, an online bookstore, right? But that point of time the idea was very new. People were not so accustomed to do this kind of shopping online, so people were more like prone to go to bookstores and do it. They were not so accustomed to some disruptive innovation kind of a framework, right? So what would happen is that, so standing on that day, I am an investor, right? So there is a venture capitalist who comes and finances Amazon. Amazon gets listed in the stock markets, or like the shares are floated out. Now, based on that idea, right, on that expectation that Amazon can do, can create magic over time, people just go ahead and start investing in it. But the nature of the business is such that for the first 5 to 10 years, you might be running on losses, and then you start seeing the money, right? So basically, what would happen is, I do not know that whether after that 10 years or that 5 years, I would actually be able to see the money, or I have to close down my business. But over there is an idea that, okay, this is an online store and this has these possibilities, this is unleashing these possibilities and so on. So it's an expectation solely based on possibilities. I'm not banking on fundamentals. I don't know if I hold a share of Amazon, whether will Amazon pay me a dividend at the end of the year or not. So what I am involved in is a gaga, right? That I'll just take the stocks, I'll see the price rise, I'll sell it off to someone, someone will buy it, and that is the way it happens, right? So initially, when a company gets launched, the share price is very less. So your idea is that, okay, this is the idea that this company is bringing in, and it can go to this part. So there is a projection, nothing else, and based on that projection, you are just investing your money into it. Right. Now you do not know what the fundamentals are. The company's share price may not actually be worth anything. Suddenly you realize that for a share which you brought for 10 rupees, because of some unknown factors, because of some sheer exuberance, because of some sheer gaga which was going around in the market around some thought, you had started investing money into it, and you see that the share price is that share is trading in at say 100 times what the original price of the share is. But the question is, had the fundamentals of the company changed in order to support that growth? So has Amazon as a company changed during that time, during those 4 5 years, to support that growth in the stock price? So that is where the fundamentals of the company come in, and the fundamentals are classically defined in terms of the dividend stream that they are likely to pay in the future. So today, if it is 10 rupees, what is the probability, or how much of return do I expect in the next 10 years, or in the next 5 years, or in the next 1 year? So that future stream of dividend, right? So where the price can go and where it is trading, that difference determines how, or that gap is what is your irrational exuberance. Now overnight, I cannot gain, my company cannot just grow 10 times or 20 times in size, or in a span of 1 year. So that takes time. Now today Amazon has strong fundamentals, it is doing wonderful business, and their stocks are really trading at very high prices, and that's absolutely okay. I know that if I invest into Amazon, I'm not going to be a loser. But when Amazon actually started off, I did not know where it would go. I cannot see the future, right? So when I'm doing that, and or when I'm trading like that, on so when I'm just trading based on the market sentiments and what people are saying around me, rather looking into his financial statements or into his fundamentals, that is the part where I am running into irrational exuberance, right? If I do it for a proper bank today, a multinational bank, I would not be doing that, because I know there is a brand name associated with the company, and the stocks cannot suddenly overnight go valueless until and unless a huge fraud or a huge illegal activity is identified within an organization and the organization collapses. But those chances are relatively less, right? Clear, Abhishek?
Yeah, absolutely fine. So, alternatively to my question,
Mm-hmm.
so if I say it's just for an example,
Uh-huh.
investment in any new startup,
Hmm.
a high increase of investment in any new startup
Mm-hmm.
is a irrational exuberance.
No, irrational exuberance is not only an investment, right? So it is a kind of a phenomenon, which is, but it's an occurrence which prevails on the market. It's a kind of a market sentiment, where on the whole the market is not evaluating by the fundamentals, but they are just going by the market sentiment that is prevailing, and on the expectation that I am just investing because I believe that it's a wonderful idea to invest in, and that will get me huge profits. right? So for example, when this online business or the app business started coming in, right? Now it has been
Yeah.
quite sometimes that app business have survived and people know what their actual potentials are. But say for
Hmm.
example, when Flipkart or Amazon, I mean, when Flipkart or Snapdeal they came into India, I mean, when they came into existence, right? What had happened? So that was an idea at that point of time. I don't know how the business is going to survive. So had they floated out stocks in the market and people would have been buying it like crazy, right? So then that would have been called irrational exuberance. Now, investment is not irrational exuberance. Irrational exuberance is a term, or it's a kind of a market mania. When I say that a market is undergoing a mania, that's irrational
Yeah.
exuberance. So it's a prevalence
Okay.
of a collective sentiment in the market. It's not that investment. So when on the whole the market is investing into a company
It's
based
it's
on
the
an
investment
expectation,
characteristics.
kind of. It's a market sentiment, you
It's
know.
a yeah. Okay.
It's an extreme form of a market mania,
Okay.
right? So this term irrational exuberance was first coined by Alan Greenspan himself in the year 1996 to describe this market mania itself. Right. So yeah, so as I was saying, just to come back. So over here, this market. So basically, what I see is the asset price trajectory that I have over here, right? And if I fit a trend line to it, you will see that it's a steep exponential trend line. So what I can see is that the asset prices are growing every time. So the growth rate is growing over time, right? So next thing that happens is, so basically whenever any asset prices increase, the first question to answer is that what exactly is causing that increase, or how risky is it to invest into the asset. So to do this, a simple comparison can be done, right? So suppose I want to invest into the stocks of, say, a new startup with a new idea, right? Into an AI startup. And people are talking all about AI and the future potential that AI can actually unleash. In fact, if you can think about it, right, I can say that, or I can picturize that analytics itself is a bubble. So everyone is talking about analytics these days, and businesses are investing into analytics. They're investing millions of dollars to get our business impact. But the question that remains is, are the business impacts in proportion to the investments that is going in? So is the job that an analyst doing, is it in relation to the salary that he is getting? Right? So people quote salary packages like 20 lakhs, 25 lakhs, 30 lakhs. Now, is it in relation to the investment that companies are making? Are they reaping the benefits to that extent, or is it that the companies are simply like, they are like, because Walmart is investing, so Shopper Stop is investing, or is it like this? Right. So is there a chance that a market may undergo a market correction? Is data an overhyped concept? Now, if it is so, if the market undergoes some correction someday, they might realize that the investment that they are doing into analytics is not that worthwhile, and they might suddenly cut that off and thereby depleting the bubble. So, so basically, how risky is it to invest into one technology? Right, especially when you are investing into some new kind of a technology, this question comes in. So basically, the idea is to understand that how do I identify this risk. So to do that, what I need to do is I need to understand how that asset price is actually traveling over time versus how has the, you know the fundamentals of the company changed, or what exactly are the expected fundamentals. So basically, if corresponding to that, if I can actually plot a dividend path, right, or a dividend series, as I might say, right. So let this part contain the dividend as well. So I'll put it as DT. Right. Now I see that, say, this is how the dividend path looks like. So what you see is that at each instant, right, the gap between the dividend path and this price path is actually increasing, right? So you see that the dividend, so basically what I can clearly see from here is that this dividend path that I have over here is absolutely, if I fit out a trend over here, it's absolutely a non-explosive line. Whereas if I fit a trend line to this stock market, right, so this is a path where it is explosive in nature. So I get to see that the stock prices are increasing explosively, but dividends are not, or returns or the fundamentals of the company are not increasing to that extent. So this gap, right, will identify a bubble, and you know that you are actually investing into a bubble stock. Right? So bubble stocks are actually very risky stocks. So if you can actually identify that you are actually investing into a bubble, you know that you are actually investing into a very risky stock. And there is a very high chance that overnight, when a small market correction or a small news strikes in the market, it might explode itself into a huge panic, thereby bringing down the, you know, thereby bringing down this bubble and the asset prices, and the asset prices might crash overnight, and you might and you might actually go bankrupt, or you might get stuck with a low priced asset. So you might actually realize that you've actually over high paid up much more than what it deserved to be paid, right? So that is, so basically, if I think about this, this is nothing but a value at risk kind of a concept. So how much of value at, so what is the probability that the stock prices will not fall below a certain percentage in, in such a span of time? So that is, say basically in the next 1 month, what is the probability that the stock prices will not fall less than, or will not fall, yeah, the fall will be less than equal to 15% in the next 10 days. So that's what a value at risk is. So basically when I'm trying to assess such a risk, what I am, the figure that I'm trying to compute, or the figure to move at, is the value at risk. So this value at risk concept will be a very important concept as we move forward to this path of, of these, of market risk model development. So the concept of value at risk is something that would be of prime importance over here. That is the value at risk, right? So asset price. So basically, if you have a suddenly a high value or value at risk, then you know that there is a high element of riskiness and so on. So this is one very important concept which would be coming up over and over again, and most of the market risk models that we have involves working out the value at risk and understanding what is the riskiness, the overall portfolio riskiness, and so on. However, we would also be exploring other advanced model development techniques as well, so which talks about developing and predicting the market risk. So basically, if you have a portfolio of a stock, and you want to predict what the volatility is going to be like some years down the line, and based on that you use that input and you take your market risk or your investment decisions as well. There are uh, important metrics, right? So we'll be talking about important ratios like price earning ratio, price to sales ratio, dividend yield, etc., right? And and other different kind of financial matrices as well. So this is more or less what an idea. So these are the different ways through which market risk actually arises, right? So this is one case of an asset price risk. So you actually run a very strong asset price, you run a risk of losing asset prices, or you run a huge risk of committing to an asset price risk or an asset price shock if you are actually investing in a bubble asset, right? So these are the different ways, and going forward we would be exploring exchange rate risk, interest rate risk, and counterparty credit risk as well, right? Okay. So let's stop here for the day. Today is just day one. I would not be going into too much of it, right? So next day, what we'll do is we'll explore two things. We'll try to explore each of these financial instruments in details, and we will try to explore these different source of market risk in greater details. Right, so we'll explore, not today, we just started talking about asset price risk. We'll finish this part. So after that we'll talk about interest rate risk, we'll talk about exchange rate risk and different regulations which are there in place to regulate the market risk for a organization. Right, okay, so just one okay, so are there any questions before I proceed? Okay, great, great. So just a quick, just a short announcement, which I can adjust. So tomorrow's class I would not be taking because actually tomorrow is my birthday. So there would be a small function. Guests would be coming over. So I would not be taking tomorrow's session. And the next class that we would have is on Monday, on next Saturday, right? And adjust the CRM session. The next CRM revision session would be on Wednesday. Wednesday 10 p.m. To 11:30 p.m. IST. Thank you, Ajas. Thanks a lot, and hope to see you next week again. Thank you. Have a great week ahead. Thank you. Bye bye. Have a great week. Bye.